Okay, let's dive right into this explainer and demystify something literally all of us see every single day. Have you ever stopped to wonder how people are out there buying brand new cars, gorgeous houses, or, I don't know, those $1,000 smartphones without dropping a massive pile of cash all at once? Well, the magic word is financing. But listen closely, because financing is absolutely not free money. It's a highly effective financial tool, and like any tool, it can either help you build wealth and achieve your goals, or it can lead you straight into a mountain of debt if you use it wrong. Our goal today is to master this tool together.
Here is our roadmap for today. We're going to cover 1. Renting money, which defines what financing actually is. 2. The real cost of borrowing. 3. Your financing options. 4. The double-edged sword. And finally, 5. Making smart financial decisions. Let's get right into it.
Starting off with Section 1, renting money, defining financing.
So, what exactly is financing? I mean, it's a word we hear all the time, right? The car dealership pitches it, your bank emails you about it. It's even popping up right on the checkout screen when you're just trying to buy shoes online. But what does it actually mean for your wallet? Let's break it down to its absolute simplest form.
At its core, financing simply means getting money from someone else to buy something today while agreeing to pay it back over time. That someone else, which we call the lender, could be a traditional bank, a local credit union, a specialized finance company, the dealership itself, or maybe an online app. Basically, you get the item right this second, and in exchange, you agree to pay them back in regular monthly chunks.
Actually, a really brilliant way to look at it is this. Think of financing as renting money. Just like you pay monthly rent to a landlord for the privilege of living in an apartment, borrowing cash comes with a specific cost for using it. And that cost? That's what we call interest.
Moving right along to Section 2, the real cost of borrowing.
Let's make this concrete with a real-world example. Imagine you are eyeing a brand new laptop and the sticker price is $1,500. You basically have two options. Option 1 is super straightforward. You hand over $1,500 out of pocket today and boom, you're done. But let's look at option 2, the financing route. They offer you a $300 down payment today, followed by 12 monthly payments of $110. For a lot of folks, that sounds like a total no-brainer. I mean, $110 a month feels way easier to swallow than dropping $1,500 at once, doesn't it?
But wait, let's actually do the math on that second option. If you take that $110 and multiply it by 12 months, you're at $1,320. Now add back that $300 down payment you made on day one, suddenly your total out-of-pocket cost is $1,620. So you just paid an extra $120. That $120 is the exact invisible cost of renting that money. That is your interest. It's literally the fee the lender charged you just for letting you walk out of the store with the laptop today.
And you know, when you scale those numbers up, it gets pretty wild. Let's say you borrow $10,000 at an 8% interest rate over a standard 5-year loan term. You do not just pay back that original $10,000 principal. Nope. Depending on exactly how the loan is structured, you actually end up repaying around $12,000 total. That's $2,000 purely in interest over the life of the loan. The bigger the loan and the longer you stretch it out, the more that rent piles up.
So the huge takeaway here is that the higher the interest rate, the more expensive the loan becomes, period. Interest literally inflates the original sticker price of whatever you're buying. This is exactly why shopping around and comparing interest rates is hands down the most important step you can take before you borrow a single dime.
Okay, Section 3, your financing options.
Now that we know how it works, think of your financing options like a giant toolbox where you have specific tools designed for specific jobs. You've got personal loans, which people usually use for sudden emergencies, maybe a big life event like travel or a wedding, or consolidating other debts. Then there are auto loans, structured specifically to help you buy a car. Mortgages are your heavy-duty, long-term tools meant strictly for buying houses. And student loans, of course, are designed to help pay for higher education. You always want to make sure you're pulling the right tool out of the box for the job at hand.
But you also have your everyday tools. Credit cards are what we call revolving financing. Super convenient, for sure, but they can get incredibly expensive, incredibly fast if you aren't paying off your balance in full. On the flip side, we have this rapidly growing trend, buy now, pay later, or BNPL. You've probably seen these apps at checkout. They let you split a purchase into smaller installments right then and there. The cool part is they are often interest-free, but, and this is a major catch, they're only interest-free if you manage them perfectly and never miss a due date.
Which brings us to Section 4, the double-edged sword.
Here's the deal. Financing itself is just a neutral tool. It's neither good nor bad on its own, so we really have to look at its dual nature.
Used wisely, it is incredibly powerful. The advantages are huge. It lets you buy expensive, necessary items without waiting decades to save up the cash. It spreads those payments out, it lets you keep your cash savings safe for real emergencies, and if you make your payments reliably on time, it actually helps you build a strong, positive credit history, which just unlocks better financial perks down the road.
However, if you use it carelessly, that other edge of the sword cuts pretty deep. First off, interest can completely skyrocket the total cost of what you bought. Plus, if you're late on a payment, you get hit with expensive penalties and fees. Start missing payments entirely, and your credit score is going to take a massive hit. Ultimately, taking on more debt than your income can comfortably support is just going to severely strain your finances and cause a ton of stress.
Let's wrap this up with Section 5, Making Smart Financial Decisions.
Let's start by looking at the classic traps people fall into. The absolute biggest mistake by far? Only looking at the monthly payment. People will literally say, oh, I can afford $200 a month, while completely ignoring an insane interest rate or the total timeline of the loan. Other huge blunders include borrowing way more than you can realistically handle, missing due dates just because of bad organization, and, this is a big one, not reading the actual loan agreement. Seriously, you absolutely must know what you're signing before you commit.
To avoid those traps, I highly recommend running through a strict mental checklist before you finance anything. Step 1. Do I actually need this item right now, or can it wait? Step 2. Can I comfortably afford these monthly payments without stressing out my budget? And Step 3, the one almost everyone skips. What is the absolute total amount I am going to repay by the time this loan is done? You really need to understand both your monthly limit and the total mountain of cash you're handing over to the lender.
And finally, I want to leave you with this ultimate question to ask yourself. Have I compared different lenders and interest rates? Never, ever just take the first offer they slide across the table. Financing should be a calculated tool that you use to build your future, not a trap to drain your wealth. So next time you're hovering over that checkout button, ask yourself, are you renting money to build your life, or are you just buying chains? Thanks so much for joining me for this explainer.